Hello, welcome to this evening revision class discussion. Hope we had a nice day. So we begin immediately with the subject matter of the day. Okay. So as we did yesterday is a continuation of yesterday class discussion. It is our joy to highlight where there are similarities, where questions are repeated, and to take a deep understanding of that to be able to see how these exams looks like, to see the approach that will be highly optimized for our advantage. So this is December Day 2024, and the first question being asked is that which of the following action best exemplify the application of financial risk control? So the right answer there is purchasing insurance to transfer the cost of potential losses to an insurance company. Because remember, risk control comes with reference to insurance. There's a transfer of that risk, you know. So you transfer the risk so you don't bear the burden. However, you're going to pay a premium. So in the instance where the question says which of the following action best exemplify application of financial risk control, going through the options that we have from A, B, C, and D, like the question did say that best exemplify. So the answer is B, purchasing insurance to transfer the cost of potential losses to an insurance company. A little explanation to bring a clearer understanding why B is the best option. We are saying that recall that financial risk control focuses on managing the financial consequences of a loss rather than preventing the loss itself. Note that again and repeat that financial risk control focus on managing the financial consequences, rather than the preventing the loss itself. So that being said, purchasing insurance transfer the financial burden as it will be or when it occur, financial burden of a potential loss from the insured to the insurer in exchange of a premium. So that being said, we are saying that a B, which is a purchasing insurance to transfer the cost of potential losses to an insurance company, is the best of option, and that is correct. So while others are incorrect, A is a loss prevention techniques. For B is considered a contingency planning measure, and and D rather is a loss reduction measure. So let's look at what they said. A, conducting regular safety training session to prevent accident in the workplace. So it is not the best that is exemplified. Rather, A, as we just highlighted here, is just trying to show loss prevention techniques. Then for C says developing a comprehensive emergency response plan to handle natural disaster. So it is not the best of answer or option with regard to the question being asked. So what C represents is that is a contingency planning measure, and D is a loss reduction measure. What it says here is implementing strict quality control measure to reduce defective product. So the other options A, C, D, which is not correct with reference to the questions, we also highlighted where they best suit, assuming the question is asked in that direction. So B is the right answer. The second question about marine insurance, we discussed that yesterday, and here we are being faced again with marine insurance. According to Marine Insurance Act of 1906, the question asks which should insurable interest be when should insurable interest be present for a marine insurance contract to be valid? So the question is with reference to the Act of 1906, asking at what time should insurable interest be present for a marine insurance contract to be valid? Is at the time of loss, is simply at the time of loss. The reason being, under the Marine Insurance Act of 1906, an insured must have an insurable interest at the time the loss occurs. Unlike life insurance, the interest need not exist when the contract is first made. So C is the answer, at the time of loss. So let's go to the question again. According to the Marine Insurance Act of 1906, when should insurable interest be present for a marine insurance contract to be valid? Our answer is at the exact time of the loss. So let's look at the next question. Says dash occurs when an insured declares a lower value than the actual value of the subject matter of insurance. It's called underinsurance. Of course, you are seen by the question says is a lower value. So because it's lower value, is but the underinsurance could come to mind. If you're not too sure, like I said before, sometimes read the question very well and do some thinking, because we are all practitioners. So when you think, you can be able to, something will come to your mind with respect to the options you are seeing before you. So in this question is asked saying that occurs when an insured declares a lower value than the actual value of the subject matter of insurance. Our answer is underinsurance occurs when an insured declares lower value than the actual value of the subject matter of insurance. A further explanation could say, as been displayed here, underinsurance occur when the sum insured is less than the actual value of the property. For example, a property actual value is 10 million and the sum insured is 6 million. The property is underinsured by 4 million. This may result in the application of the average clause during claim settlement, because sometimes you think you are wise and maybe year A you declared, year B you declared, nothing happened, and human being what we are, you begin to feel that this premium, does it worth it? Does it worth it? But fear factor will warn you, or your conscience, and my friend, it's better you do what is ideal and good for you. We being weak at what we are. So okay, let me just underinsured. Nothing will happen. After all, for the last 2 years, nothing has happened, and you're underinsured. Lo and behold, something happens. Would you expect to have the actual value? Of course, you should not expect that. You should not have said that. So that is what happened in that instant. It's good to ensure what the actual value is. That is, the people's insurance is not to be astute or clever. No, the right thing should be encouraged and be done. All right, so we move on down the other question to see what we have there. See what we have there. So I dropped you something on the chat. You can respond. So look at the next questions, and we are saying here, which of the following best describe the nature of human resource risk in an organization? Which among the four options best describe the nature of human resource risk in an organization? And it's simply saying they are threats and vulnerability that impact organizational workforce. Human resources, yes. The key thing in human resources is the workforce, is the people. So when the question asked as shown here, saying which of the following best describe the nature of human resource risk in an organization? So the best answer is C in this instance, and it goes to the point by talking about organizational workforce because we're looking at the risk in that organization. So threat and vulnerability that impact the organization should be considered as being described here. A further explanation on the question in regards to human resource risk will include labor turnover, skill shortage, industrial dispute, poor morale, social challenge, So thus these risks are threats affecting workforce and even organizational performance or even organizational sustainability. So we have taken C. There C is the answer with respect to the question that is asked. So we go on to look at, the next question. We are saying in a reinsurance transaction, an insurance firm can be called any of the following terms, except we have did mention about issue of except, issue of negation. Very careful. Issue of negation should be considered very well in our thought processes. We'll read and we'll come to where the except should come down because naturally our thought pattern is progressive, it's forward thinking. And when issue of except come, sometimes you have to think in opposite direction. Our thought pattern should switch into anti-clockwise to evaluate the options and therefore make the best choice and the correct one also. So now we have except. So we will have except, we should think critically, you know, because by looking at the first few questions, is a direct question. You read, you try to make option. But this one now is trying to be anti-clockwise. Say except, you know. So by except, it means that there's likely that the three option should be correct, but which one is not correct in the instance. So except is this is not included. Except is except simply means a negation. This is not part of it. So your thought pattern could be forward thinking and you quickly take the correct one without putting the exception classification or category into consideration. So it's just to buttress this skill, have to acquire skill of negation, skill of when except is used, skill when they say this is not included. So let us reframe our thought process and be able to know is a negation before we now shade. So back to the question, it says in an insurance transaction, an insurance firm can be called any of the following, can be called any, except, so insurance firm cannot be called reinsurance or reinsured. So that is the except, you know. To explain this further, we are saying the original insurance transaction part of its risk is called either a cedant or ceding company, So the term primary insured refers to policyholder, not the insurance company itself, Sorry, I didn't explain this. Okay. Okay, so this is this. We didn't offer explanation here. So the answer is reinsurance. So the next question here is on the term primary insured refer to policyholder, not. Okay. Let's move. There's a mix up there. Let's move to number 6. So the risk management processes or process that involve 3 major steps that are systematically and also scientifically linked to one another. So which risk management process that involve 3 major steps, and this process is systematically and scientifically linked to one another. So we have it as identification, evaluation, and control. So to explain this, the major stages are risk identification. You have to identify what is the risk, you know, say this is what the issue is. That is risk identification. Then you go to evaluation or so analysis. Okay, this is what it is. You now make some evaluation. Okay, can this go? This will not go. This is what will go, and all that. This is the challenge. This is the main issue. So you are evaluating what you have identified. Then after that, you treat or you now call, have to control. So first is risk identification. Second is risk evaluation or analysis, and the final one in this context is risk control or treatment. So this sequence enables our organization to identify risks, also evaluate their importance or significance, and hence apply suitable control measure to that effect. So D is the best of option, which says risk identification, evaluation, and control. So the next question that is shown there says the purpose of creating a common pool in insurance is one of the following. Is one of the following. Why do we create a common pool? We create a common pool to pay losses of a particular portfolio from it accumulated premium. So common pool is to enable us in the time of claim, in the time to pay losses of a particular portfolio, you know. So that's why we create a common pool. The answer is B, to pay losses of a particular portfolio from it accumulated premium. You know, we record that insurance operate on the principle of pooling risks. You know, premium collected from many policyholders forms a common fund used to compensate the few who suffer losses. Incidentally, the way this operates, a game of number, and we don't suffer losses at the same time, the same day or so. There could be one or two coincidence, however, there could be one or two, but it's not all policyholder at a given time or period will now suffer loss. You know, it doesn't happen that way. You know, so now the premium that's collected from these various or many policyholder forms a common fund that will be used to compensate those few, of course, most of few who may now suffer loss. You know, so the answer is to pay losses of a particular portfolio from it accumulated a premium. So looking at the next question, it says, after reviewing your claim, your insurance sent a settlement offer along with a discharge voucher. Which next step will be appropriate? Of course, when you have there is sent a settlement offer along with discharge voucher, of course, they will be signed and return the voucher once the claim is settled. You know, sign is just to acknowledge, yeah. So to explain this further, we'll say a discharge voucher is evidence that the claimant accept the settlement. Or I agree with what's going on. I'm fine with it. The insurer has fulfilled its obligation. It's also a testament. You know, sometimes many people have been disappointed either by way of time to fulfill obligation, a lot of bottleneck, a lot of challenges. Claimant get discouraged when the money finally paid, a lot of things. So one or two must have experienced it in that very discouraging way. But on a general note, is a thing that is working and is encouraged, you know, to get involved in insurance. So insurance are true to their name, and they did also fulfill their own obligation. If the insurance is in the beginning set right, they do. So in this question of after reviewing your claim, your insurance sent a settlement offer along with a discharge voucher. And the question is, what next step should be appropriate? The next step that's appropriate is signing and returning the voucher. Discharge voucher once the claim is settled. I will have explained further saying that a discharge voucher is evidence that the claimant accepts the settlement and the insurer has also fulfilled its obligation. So once that is settled, you know, once satisfied with the settlement amount, the insured sign and return the voucher. So to sign and return the voucher, is the best option. Okay. So what is the primary distinction between risk and uncertainty? We have had this before. I think this is a repetition in one of our earlier discussion, that what is the primary distinction between risk and uncertainty. And we did say that risk involve probability estimate, while uncertainty lacks such a probability estimate. Yes, because risk, you can say, you can quantify it. You can say, okay, can make some kind of probability estimate. But like I said in the previous class, when you say uncertain, uncertain is the thing you don't know. I'm not sure, or I don't know. It's not. It's uncertain. You can't give any figure. You can't make any quotation. You can't make any estimate, because the underlying factor is that I don't know, I'm not sure, I'm not certain. Hence, you can't be able to present anything. But risk, you can make a probable estimate that can be valid or justified. So the primary distinction that exists between a risk and uncertainty is that risk include probability estimate, while uncertainty, like the name applies, lacks such probability estimate, So to offer a further explanation to the choice of C as choosing here, according to Frank Knight, he said risk, future outcome can be under risk, right, to talk on the two. So considering risk, according to Frank Knight, he said future outcome can be estimated using probabilities, but uncertainty, future outcome cannot be assigned a reliable probability, So try to see this example. Saying probability of fire in a building is a risk. Future political observer is uncertain, even though you cannot say, but a fire, yeah, when a fire occurs, it's possible, but you cannot say Nigeria will divide in the next election. There will be trouble. You can't say that. You can't say that. It's uncertain. You can't come out with anything from that. So the difference between risk and uncertainty, we have said before, with the option is C is the correct one, and C simply says that risk involve probability estimate, while uncertainty lacks such a probability estimate. So we'll go on to the next question and see what it has. So that is the way it goes. And we did discuss most of these things in the class. So let's look at the next. To reduce the risk of low employee morale, to reduce the risk of low employee morale and high turnover rate, which action should an organization take? Which action? I think we have had a question that is similar to this in one of our discussions yesterday or 2 days ago. He's simply saying to reduce the risk of low employee morale, getting discouraged, not being satisfied at work, and also people are leaving high turnover rate. So when this occurs, he's saying, what action should an organization like mine, like yours, take in this instance? And we have a various options. One say conduct comprehensive risk assessment. Others B say develop clear recruitment policy. C say invest in employee training and development programs. And D say update policy regularly. So the answer is C. Because to offer further explanation, if an employee receive a career development as highlighted on C, and also skill enhancement, and there's a growth prospect there. So these tend to bring about a high or higher job satisfaction and even a lower turnover, because the employee is empowered, sees a future in that organization, a skill enhancement. So the answer is C, that says investing in employee training and development programs. So that is it. The next question talks about or asks us saying the primary motivation behind government supervision of insurance business is because of what? I think we have seen this in one of our question. We have seen it in one of our question. They are the primary motivation behind government supervision of insurance business. The answer is C, is to protect policyholder from exploitation. You know, is to protect policyholder from exploitation. Because insurance regulation is a primary to protect policyholder, also ensure solvency of insurers and promote confidence in the insurance market. So government supervision or interest is in the insurance business. It also, as well as insurance sustainability, you know, indirectly is also insurance sustainability. But on this question or on this instance, the answer is to protect a policy holder. And when policyholders feel they are protected and it is true, so there will be game of number. People will come in and get involved, and the insurance business in other hand, or in other words, is also sustained. So government is doing a lot to provide supervision to see that the business business is sustainable. So, but primarily business the supervision is to see that policyholder are protected from being exploited. So we move on. So looking at the next question we have, say which of the following peril can be added to a standard fire policy to make it a fire and special peril. We have said this before. It is storm and food. In this instance, we have said something about fire and special peril policy yesterday. We said that. So you can see how questions can be repeated. Hence, this revision is very important. So which of the following perils can be added to a standard fire policy to make it a fire and special peril policy? The answer is storm and flood. Special peril commonly added to fire insurance includes storm, earthquake, impact damage. So the answer is storm and flood. The next question we look at says, how best will you explain consensus ad addendum as an element of insurance contract? Consensus ad addendum, how best is to agree, meeting of the mind, consensus. So it's agreement. And sometimes it's not acceptance. We have consensus does not mean we accept it, but a little left, a little right, we agree, So the answer is agree. That is B. Both parties must agree on the same term and subject matter of the contract. They agree before we proceed. The next is, let's look at this question, very interesting question. It says the measure of the likelihood of the occurrence of an event is called what? It's just a simple English language. It's not hazard, it's not peril, it's not uncertainty. It is probability is the measure of the likelihood of the occurrence of an event. The answer is C, probability. So probability measures the chance that an event will occur. Example, probability of death, every one of us, is a probability. Anyone that is living will die. There's a probability that a point a one will die. Probability of accident, probability of fire, these are probability. So, but then why others are incorrect? Hazard simply means hazard increases the likelihood of a loss. That's hazard. For example, in your office, the cleaner is not supposed to clean even before staff resume by 8, as the case may be. Cleaner should be in the office 6:30 and clean up. But the cleaner is not done. Time is there by 5 after 8, and the floor is wet. So that floor being wet is a hazard. There's a likelihood that those of our sisters with high heel can easily hit their head. Step on the wet ground, it can drag you. So that is a hazard. Hazard is increases the likelihood of a loss. Why peril is the cause of loss itself. Peril is the cause of loss. Uncertainty refers to lack of knowledge about outcome. I don't know what will happen. That's uncertainty. So the question being asked here simply say the measure of the likelihood of the occurrence of an event is called probability. C is the answer. We move on to the next, saying the question here is simple, say to reduce the risk of low employee morale and high turnover. This also is being repeated here, it's been repeated to reduce the risk of a low employee morale and high turnover rate. Which of the following actions your organization take is to investing in the employee training and development program to enhance skill and job satisfaction. We have mentioned this before, so this is also occurring again. So take note. So low morale and high turnover often results from lack of career growth, poor employee engagement, or inadequate training. Also limited promotion opportunity. One is discouraged, you know. So why the option C is correct, that is investing in employee training and development program to enhance skill and job satisfaction is because training and development improve employee competence, also enhances their motivation and career progression, as well as organizational commitment. So employee who sees opportunity for growth are more likely to remain within the organization. So that is why C is correct. Move on to the next. Say the primary motivation behind the decision to introduce government supervision is so it's being repeated here. So this year has a lot of repetition, you know. So the primary motivation, we have answered this before, is to protect policy holder from exploitation. We have explained that before. So we look at the next question again. Which of the following can be added to standard? So this and this, we have answered this. Okay, no, I think I'm the one who is not moving faster. Sorry. Okay. So I think we'll stop at here so that as we stop the other day, we'll continue from here next revision discussion, you know. So we're going to stop here, or let's just answer this and start and stop here. So a homemaker wants to ensure the property is fully covered in an event of fire. If the property is valued at 5 million naira, how should they determine the sum insured for the property insurance policy? Is by choosing a sum insured equal to the market value of the property. So you choose what is equal to that market value. That's the best way to do that. So A is the answer. To explain further, we say the sum insured should reflect the property actual value. So the option A is correct. Why? If the property is underinsured, like we have discussed before, the average clause may apply and claim may be reduced proportionately. Therefore, the sum insured should always correspond to the property full value. So that is the insight we just share. Thank you for being available. Thank you for being available. So we are going to continue from where we stopped today by tomorrow, God's willing. Thank you very much. Okay.